June Toronto real estate market did not hold its ground against Bank of Canada's ninth interest rate raise. Average sold price stopped the increase after 4 consecutive months. The transaction volume also retreated back to April's level after May's increase. A couple days ago, Bank of Canada even announced its 10th interest rate raise in July. So where the market is heading to? Hi, this is Pris Han from your Home Sold Guarantee Realty team, Pris Han. Today, let's take a look at the newly available June Market Watch report. So before we look at June real estate market stats, I want to review Canada prime rate changes during the past couple of years because interest rate does impact our borrowing power and also the cost of interest. So here it goes. During pandemic, Bank of Canada reduced interest rates 3 times, so it went to 2.45%, which is the lowest for a very, very long time, couple decades. Then we remain at that level for 2 full years. And in those 2 full years, the real estate price really peaked last year in March. It went to historical high. And then March last year, we had the first interest rate raise, and it came to 2.7%. And ever since that, in less than a year and a half period of time, Bank of Canada had 10 times interest rate raise until July 12th, and the prime rate now is looking at 7.2%, which is highest in the past 20 years, over 20 years. We did had a stop for 4 months. The first time interest rate raises in January this year, and ever since that, we haven't had the interest rate raise for 4 months. February, March, April, and May, in these 4 months, the average sold price had 4 consecutive months in recovery. And if you watched my video, you probably remember during that period of time, the market picked up 15% from January's lowest point. So in the future, will we have further interest rate raise? It highly depends on Bank of Canada's own decision, because they did say the reason they launched this interest rate raise is because they want to control the inflation. They don't want the economy have overheat. So the target they mentioned a couple of times is 2% inflation rate. Although currently we are having a 3.4% inflation. So this number still has some gap to the 2% target they set for themselves. However, this is already the lowest level in the past 2 years. So will they have another one in September? It's your own judgment, but these are the background data. All right, now let's take a look at the market stats. So the market did react to June's interest rate raise. Remember, we had 4 consecutive months average sold price increase from February to May, right? That trend got stopped in June. Average sold price came down from 1.196 million to 1.182 million. It's not a very significant decrease. However, it did not continue to grow. Corresponding to the sold price drop, the number of sales shrank more drastically. In May, if you remember, when I run the Market Watch report, I said both transaction volume and sold price jumped up quite significantly. But this number, the transaction volume actually came down quite obviously for over 1,500 properties. So we sold less than 7,500 this month. Obviously, it's telling us many buyers, they hold their horses back. They want to observe further if this interest rate raise is going to bring the price further down. So buyers are holding themselves, but the sellers, did they rush to the market? The answer is no, because the new listing, it almost remained flat or slight increase than May. You can see last month is 15,200 and this month is 15,900. Yes, there is an increase, but not too drastic. You at least we cannot say that the sellers are panicking and then just rushing to the market. There's no such phenomenon. But because the sold volume reduced quite significantly, the overall active listings or the inventory in the market become a lot higher. So active listings showed more than 14,000 houses. This is a quite higher number than last month's 12,000. Since the inventory is all of a sudden abundant again, you can see the level of inventory jumped up from 1.3 months to 1.9 months. So it means that carrying current sales speed, it will take almost 2 months to deplete all the available listings. So 2 months inventory, we shouldn't say it's too high, since if you remember in January, the inventory was 3 months. However, it did change the trend that inventory is shrinking from February to May. And also the market also stepped out from seller's market back to balanced market again. Average days on market remain the same, still 14 days, and 14 days, I would say it's a median for days on market. It's not too long, it's not too short. Shortest we've seen 8 days, the longest we see close to a month. So this is about average. For across different properties, we do see they are very correspondent to the average sold price drop. It's around 10K, it's not very visible. So for overall June, I wouldn't call the price change too drastically. It's just buyers show apparent sign of holding themselves back. So the transaction volume, the market activeness reduced more obviously than the price decrease, right? So across the whole different property type, they're pretty much the same. All right, in the past couple months, I've done a lot of analysis about supply and demand, and also the property price corresponded to the interest rate. So this month, I want to compare GTA, the Greater Toronto Area, to other major cities in Canada. In my previous videos, I talked a lot about the GTA real estate market. Today, I want to compare 4 major cities in Canada about their price trend during the whole pandemic. So these 4 cities are Calgary, Montreal, Vancouver, and Toronto. And the number we're looking at is called HPI, benchmark price. And this is a statistic tool invented by Korea, Canada Real Estate Association. So if you're interested in how it's calculated, you can go to their website and take a look. So here it goes. The whole observation period for the pandemic starts from January 2020 and ends in June this year. So the whole period is about 3 years and a half. All 4 cities review similar trend. It had their peak at last year, spring, around March, April. And since Bank of Canada launched the interest rate raise, the market price start to decline. And earlier this year, because there's a pause for interest rate raise between February to May, so all those 4 months, all 4 cities came back, regained some growth. So what I want to draw your attention today is to see during this recovery, the first half of this year, how much gap do these 4 cities still have against their peak in last spring. So here it goes. For GTA, we're almost there. We're still having 4.6% gap. For Vancouver, because last year it really went up high and then they end up decline further. So now they still have 11.5% gap. Calgary is very interesting. Calgary actually not only regained all the loss, it actually 3.9% higher than last year peak in May. And then Montreal still have 6% gap. So you can see all cities regain quite a bit of loss. But are all these 4 cities going to carry on the same trend? I think it highly depends on how the buyers will react to the July interest rate raise. And then possibly there's another one in September, right? But before we end this video, I want to leave you one question. If we compare today's price with the beginning of the pandemic in January 2020, one of these 4 cities had 47% growth, which is the highest among 4 cities. Do you know which city is this one? Leave your comment here. See you in next video.